Cast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the Summer 2021 Linneman Associates Capital Markets webinar. This is Bruce Kirsch, your host, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. We're pleased to have an insightful program for everyone today. It's going to be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and I would like to address just a couple of housekeeping items before we get started, just to make sure everyone is comfortable. On the audio front, all of your participant audio is muted, meaning we cannot hear you, and that's by design and will remain the case throughout the webinar. If you're attending by computer, take a moment now just to familiarize or reacquaint yourself with the control panels. We will be showing the slides, but if you'd like to download them, you can find them in the handouts section. Click on the file name and it'll download. You don't need to have the slides up during the presentation because that's what we are going to be showing, but they're there for your future reference. And we've, as always, reserved 15 to 20 minutes at the end of the webinar to answer questions. But please feel free to submit the questions at any time during the presentation. Just click in the questions field of the control panel, type in your question, and make sure you click the send button. If at any point during the webinar you get disconnected, just reconnect the same way you did initially. If you are registered, you will automatically receive an email link to the recording of the webinar about an hour after the completion of today's session. So welcome again, everybody. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, happy August to you.
Yeah, hot and humid in Philadelphia, but that's Philadelphia in the summer. So, Bruce, let's start with the slide that has the beautiful butterfly on it. And as those have followed me in these presentations or in Linneman letter, I've deemed this the butterfly recovery starting about a year ago, namely as society opens and closes and as we are afraid or not afraid of the virus, the butterfly recovery moves forward. And it moves forward, but haltingly. And the reason I picked the butterfly is it doesn't move fast. It stops, it goes sideways, goes up, goes down, even occasionally goes backward. So the question is the butterfly over yet? And the most important question in that regard is if you go to the next chart of what's the status on COVID. And what I put here are deaths. And while it is true that deaths lag cases by a couple of weeks, I find deaths a better metric to follow for the simple reason that that's what I think most of us fear. It is pretty highly correlated with hospitalizations. It is less highly correlated with cases for a variety of reasons. And what you can see if you look at this is we are still quite low in terms of number of deaths. Cases are way up, but deaths are staying, thankfully, pretty low. That obviously reflects the most vulnerable people have generally been vaccinated. And while there are still a lot of unvaccinated, unfortunately, the situation is not unbearable awful as you saw back in late winter, or you saw basically a year ago, or you saw in March, April, May last year. So stay tuned. The good news is that booster shots are on the way, which will be a great boost to the economy. The bad news is winter is coming, and just intuitively one expects that to be worse. So what does this mean? It means people are getting more cautious. People are worrying about what to do. On the other hand, activity is pretty good. And as you'll see as we go through the data, you're seeing we're kind of in a fluttering phase of the recovery where we're more or less staying in the same place the last few weeks. But it's an improved place from where we were 2 months ago, 4 months ago, 6 months ago in terms of the economy. The next month or so is going to be very important in terms of what happens to this chart and spilling over to the economy. So let's then go from that. And the only reason I like this chart also is it tries to sort out the headline and the fears. So go to the next chart though, and it says it really depends on what happens from here is how hard does Delta or Lambda or any other variant hit the unvaccinated, and to what extent, if at all, will government shut things down to protect the unvaccinated, and to what extent will they intervene to make the unvaccinated get vaccinated? Those are all unknowns that are still in flux, and they have important economic implications. The federal unemployment insurance top-up is slowing the recovery. We'll talk about that, but it's probably slowing the recovery. We should have 3 to 4 million more jobs by now if we didn't have where people making less than $25 an hour. Now in most states, there are a few states that have not accepted the money recently. But that ends September 6th. We'll go back to a more typical situation where if you're unemployed, you make somewhere between 45 and 55% of what you could make if you work. That's a dramatic change, going from making 100 to 115% of what you could make employed by being unemployed to making 45 to 55. So I think as that burns off, you're going to see a lot of these labor market situations ease. They're not going to disappear overnight. They're going to ease in September, October, and into November. The capacity reductions that were put in place in late March, April, May, June, July of 2020 are slowly unwinding. And they have, after creating shortages and price surges, just the oddity of the used car situation. The used car situation, by the way, if you don't know, has to do with as the car rental companies, which are a large source of used cars, were going bankrupt in March, April, May last year. They dumped huge amounts of their fleet onto the used car market. Used car prices went down dramatically. They then survived. The economy rebounded. People wanted to rent cars again, and people wanted to buy used cars, but the used cars aren't there because the car rental companies are no longer putting in a lot of cars into the used car pool. So that saw car prices go up. About 20% of the inflation last month was attributable to used car prices, just to show you how bizarre the world is. And that used car price, also as the rental cars aren't available, that's because they got rid of their fleet a year ago. And now as demand's coming up. So you have all these kind of odd situations of capacity reduction, and they're unwinding, getting back to normal. But in the meantime, there were price surges. Those surges are reversing. You see it in lumber. It's reversing. It's not completely reversed. I still think that post the federal unemployment top-ups ending, you're going to see employment surge a lot, and you're going to see the last quarter of 2021 be the beginning of the real roaring 20s, unless COVID really runs rampant. And while the vaccines are not perfect, they are extraordinarily helpful. Go to the next chart. It's unemployment. You see youth unemployment in the red with its average, and you see the total unemployment in the blue with its average. I've always liked the youth unemployment because it's a hyperreactor. And as a hyperreactor, it's a great indicator of what's going on. So you can see it skyrocketed faster than did overall unemployment, but it's also recovered better than overall unemployment. Now, the reason it's recovered better than overall unemployment is the kids coming in, the 16-year-olds, the 17-year-olds didn't have a job. Since they didn't have a job, they couldn't collect unemployment benefits. Since they couldn't collect unemployment benefits, they couldn't make more not working than working. So they had to go to work. And you saw how powerful it is in the labor market that they have seen their unemployment rate go to near record lows. And that's because they're getting jobs that are available because the older unemployed don't have to go to work to make a living. So this unemployment rate, especially the blue, is deceivingly low. The good news is it's massively recovered. I think the official is 5.4%. But if you go to the next, you can get a real quick apples to apples summary of the unemployment/employment overview versus February 2020, that is just prior to the pandemic. So February 2020, you had 5.8 million unemployed out of about 166 million labor force, and that was the 3.5% unemployment rate. Today, the official unemployment rate is 5.4%. However, there are 13 million people currently receiving some type of unemployment benefit. If you say the unemployment rate would have grown from 166 million to around 167 million over the last year or so, and you say you've got 13 million collecting unemployment benefits, you just do the math, and that's a 7.8% unemployment rate. And that doesn't count the people not receiving unemployment benefits who are unemployed. So it's at least 7.8%, not 5.4, probably closer to 8.5 or so. Another way to view it is the current unemployment benefit claims are roughly consistent with a 9 to 10% unemployment rate. And another way to do it is to think about, we have about 152 million people employed today. And again, if you compare that to the labor force should be around 167 million, it is not that high, but it should be, but for. So 152 million employed suggests something like a 9.6 unemployment rate. I don't know exactly what it is, but I know it's a couple hundred basis points higher than the official rate. And there's a number of reasons for that we don't need to go into, but one of them is the next chart. And in the next chart, you see the labor force has dropped by about 3 million. So instead of the labor force growing over the last 18 months, which would be typical to have the labor force growing by 1 to 2 million over an 18-month period, it's down 3 million. Well, if there was only one person in the labor force and they were working, you'd have zero unemployment, but a lot of people not working. And that's a bit of what's going on. And in fact, what you can see, the red line just puts its previous high so you can see it. What you can see is the butterfly. And since really July, August last year, the labor force, the official labor force, is just kind of fluttering around. It made an initial rebound and now is just fluttering around. And so this is one of the reasons why we're not quite back. Go to another next chart, real GDP, again, we put in the previous high in red, the pre-COVID high from the fourth quarter of 2019. In real terms, we are almost exactly back to where we were. So another way to think about it is real GDP is recovered, but we have about 5 to 7 million fewer workers. And that means productivity is up. It means the unemployment is concentrated on lower value add workers. It means, though, they're not fully back to the economy, and they're an important part of the economy. And so we still got a good distance to go in this recovery to get back. Another way to view that is the next chart, and you see real GDP potential in the red. And all that is what if over the last basically 18 months, it's a little longer than that now, but 19 months, what if GDP would have grown at 2.5% per annum? That's what the red line would have been. And you see where we are in actual GDP. So even though we're back to the previous high, remember during that time we should have grown. So we're down about 3 to 4% from where we should be. We're down probably 8 million people working from where we should be. Again, concentrated in the lower value add sectors. And that's why I believe you're going to see a surge coming forward because of the unemployment benefits burning off. Go to the next chart, weekly unemployment, new unemployment claims. It's way, way down. You see that what happened last year is totally unprecedented. We now are back down to levels that are similar to what we had during the financial crisis or during other difficult economic times. So we are not fully recovered by any means in this regard. And you're going to see, again, more improvement there. Go to the next, what's private sector employment. And this is, you can, again, we put in the pre-shutdown peak in the red just to help your eye. And you can see we're several million short in the private sector. All you have to do is look around, walk around, and you see the help wanted signs. If suddenly people have to work again, you're going to see this shoot up. And I fully anticipate this blue line to be well above by the time of our next session, I expect the blue line to be above the red. And that's because I think you're going to see a real surge post September 6th as people say, oh, gee, I have to work. Go to the next. Let's change tone a little bit. Real is just adjusting for inflation. Real net worth per household. We're at an all-time high. And the red is the long-term trend. It's a geometric trend because wealth grows at a percentage rate. But be that as it may, we're above trend. And my comment is, I think the reason we're above trend is we're way above trend in the terms of the amount of money chasing assets. We've never had this kind of money chasing assets. And unique amounts of money chasing assets create unique pricing of assets. Go to the next. How's the household in terms of its debt burden and its savings? And you can see the savings rate in the blue and its index, but you can see that people have a lot of savings compared to the historic norm. And you can see their debt is quite low relative to disposable personal income, DPI. So people have a pretty clean balance sheet and a pretty manageable debt burden out there. Let's switch to real activity. Real retail traffic, this is foot traffic, percent change versus February 2020. So the denominator in all these is where are you at versus 2020. And you can see that it's been a rough road since the pandemic started. And it basically always was below. And we have just gone in the last 2 months to where there's more retail traffic. This is at brick retail traffic than prior to the pandemic. Now it's slowed a little bit in the last couple of weeks, but people are back shopping. And those of you who followed me said it was nonsense to say that people weren't going to go back to shop and online. That was just nonsense. Brick is an important part of the shopping retail experience. And in fact, it's also an important part of the online experience in terms of picking things up and then buying other things while you're there. So this looks quite good. Go to the next. This is real e-commerce sales. And the interesting thing is you can see how it dramatically shot up as the shutdown began, just dramatically shot up. But since then, it's been flat. And that's because as brick opened up, you were able to go back and shop where you wanted to shop. And in fact, if you go to the next chart, you'll see real brick sales as best we can estimate them. Again, the red line is showing you the pre-pandemic peak. You can see that from that pre-pandemic peak, as real brick sales dramatically fell because so much brick was closed. But now, as you've been in 2021, real brick sales are actually outstripping their previous peak. And in fact, they're rising quite dramatically. This includes restaurants and other activities. So you have a lot of good things happening out there. Meanwhile, if you go to the next chart, remember I told you e-commerce sales were flat, but if you look at them as a percent of total retail sales, not including auto, they're going down as their share of sales is declining. And it doesn't take a genius to say, gee, I think it's going to be declining to a very positive trend line. Or another way of saying is, if it stays the pattern it's at, in about a year and a half, the positive trend line is going to come up and meet the actual. And then from there, it will be back to where it was. That is, lots of the sales that happened e-commerce were nothing more than a transitory emergency exercise rather than a long-term adjustment. But overall, e-commerce is growing. Go to the next, and I don't know any better way than to ask this question. Where are we at in terms of return to office? I say if you ask a stupid question, you get a stupid answer. If you ask people, do you want to go back to the office to work? And most of those surveys say, no, most people want to work at home or at least several days at home. But it's a stupid question. The real question is, do you want to work at home if, in fact, most of your colleagues are working at the office? And if you continue to work at home, you won't get as good a raises or as good a promotion opportunities or as good a socialization. Or would you rather come back to the office? And I think you'd get a very different answer to that question, though I've never seen that question asked. So my belief is basically people are, of course, going to go back, but not until it's safe. And you've seen a lot of firms recently say, let's hold off another month or two and see what happens with Delta. They're not holding off because productivity is so wonderful. They're holding off because of safety. And that's the limiting factor. International evidence where Israel and others would suggest that people do come back. And it's because it is more productive. And if I'm in the office and you're not, or my company is in the office and you're not, I have a competitive advantage most of the time, not every minute, but most of the time. And it's hard to get a competitive advantage in a competitive industry and in a competitive labor market. And if being at the office gives the company and the individual a competitive advantage, they're going to do it. I always find it kind of interesting. People complain about how horrible the online school system experience has been. And why do you believe online work has been much more relatively productive? The other is business couldn't have been that wrong. There were enough clever people, somebody would have figured it out already. And the reasons are this productivity, competitive advantage, social interaction, office politics, namely, do I get the plum assignments? Am I around the people who are rising? And then I always say, or at least my wife says, for better or worse, but not for lunch every day, is not the bargain we struck. So I think people go back, but not until safe. Hotel rebound, we've been saying from day one, of course they'll rebound. Domestic travel is doing quite well, even in face of Delta. It's doing quite well. You're seeing a lot of pickup in hotel rates. Yes, they're coming off the floor. We're social animals. We like the travel. We like experiences. In terms of business travel, there is a competitive advantage associated with it. Leisure experiences people want. The big lagging component is international. I recently went to Germany and Iceland. The international travel experience in the airports is pretty crazy. They don't have labor here or in Europe. But that will be resolved. But these labor shortages are a huge, huge problem at the moment, especially on international travel. How about multifamily? What's the status there? You still have some softness in the urban core multifamily. However, they appear to have hit bottom around February this year. Since then, there's been notable strengthening. They're not back to their previous peaks in many cases in the urban cores, the major urban cores, but they're strengthening. People are moving back, and especially as offices open up to a greater degree, you're going to see even greater strengthening. You've seen they strengthened as urban amenities, restaurants, et cetera, open. Doesn't mean the suburbs are weak. The suburbs are still quite strong. A lot of people who would have moved to the suburbs 2 years from now already moved. And we wrote about this in Linneman letter a year ago, that there would be a time shift. So the suburbs are strong. Involuntary savings, that is, my vacation got canceled and I had money and nothing to spend it on. And COVID inheritances. And what I mean by that, your grandmother died 4 years earlier than you thought she was going to die last year because of COVID. And you received your inheritance 4 years earlier than you thought. And so last year and early this year has been flooded with a combination of involuntary savings and unexpected COVID inheritances, which have allowed down payments, which have fed single family ownership. Now, over time, those are both going to normalize, and we certainly hope the early COVID inheritance phenomena normalizes. Demographics for multifamily look solid, and supply is not out of control. Interestingly, as demand boomed, you also encountered high construction costs, so it's kept things in decent balance. Multifamily looks pretty good these days. You can find exceptions. What about warehouse? Go to the next. The strong demand continues. And we've written about this in Linneman letter. the main phenomena driving this is that every online retail sales needs about 3x, 3 times the amount of space than if that same item was sold in the traditional brick manner. And it's not algebraic, it's approximate, but that means the ongoing shift to retail sales to online creates an outsized increase in demand for industrial warehouse space. And so that even though the supply keeps increasing, it's continuing to lag demand growth. And this will continue for a while. The other interesting thing is 10, 15 years ago, institutional investors did not view industrial warehouse as an institutional investment class, and it is today. Much like multifamily in 1990 was not viewed as an institutional investment class, and very much is today. So you've got terrific supply-demand dynamics in warehouse. You've got lots of capital flow, and strong pricing continues. Go to the next, and we've got RCA's transactional real estate values shown here for office, which is kind of down, but not off the charts down. You've got for retail down notably in terms of its valuation. And you can see industrial just keeps rising in real terms through the pandemic. You'd have no idea anything happened. And then if you go to the next chart, you see multifamily in the blue, where again, you see quite strong values. They were hit a year ago, but they've bounced back. And hotel got just crushed, but they bounced back. They're not back to peaks. They're nowhere near their peaks, but they're making a great comeback. Go to the next. These are implied cap rates for REITs at the end of 2019 versus today. Multifamily cap rates on Wall Street down notably, up a bit for shopping centers. At the worst, they were up a lot, but they've kind of recovered. Similarly for mall, similarly for office, but industrial, the cap rates have come down dramatically. And so you have the two categories that are quite in favor, multifamily and industrial, where the supply-demand fundamentals are quite good and quite clear. The retail and office, where the activity is less clear moving forward, still having a modestly higher cap rates. Next chart is what happens though if people come back and as they shop. As risk recedes, the interesting thing is if you think about values as discounted cash flow, the worst cash flows are behind us, and that pushes values up. In addition, as the risk recedes, discount rates fall, and that pushes up values. There's a lot of liquidity injections that the Fed has made, and those are going to chase assets, and that will increase values and reduce cap rates. And as a result, we believe that not every day, not every week, not every month, but the secular direction of cap rates over the next 7 to 10 years is down by as much as 10%. And I know we all put in our models, cap rates are going to be 50 basis points higher when we exit. I just don't think that's going to be the case. I think you're going to see a secularly lower. Next, let's just step back and take a look at the federal debt per household, up, up, up. This is pretty unprecedented if you look at it. I mean, that's a lot of debt. You see the debt we put in to deal with the financial crisis, and then you see again the debt that we put in to deal with the COVID crisis. Go to the next. This is total debt outstanding. And you can basically see it's all about the government, which is the green, increasing. The household debt has fallen, non-financial business about the same as a decade ago, a little higher. But the one sector that's dramatically up, really dramatically up, is the government sector. Go to the next is just a quick 4 generations, if you will, 3 generations, 54 to 73. Expenditures outran revenues as a percent of GDP by about 90 basis points. From 74 to 2007, they outran them by about 230 basis points. And since 2008, they outrun them by about 600 basis points. And at the rate we're going, it's outrunning by about 1,900 basis points. This is clearly not sustainable. And so the next chart shows you federal debt as a percent of GDP. And we're basically where we were for World War II. And in fact, we've been there longer. Now we're a richer society. And by the way, if you look at this chart, it's quite interesting. Way back, you see the Revolutionary War debt. You see the War of 1812 war debt. You see the Civil War war debt. You see the World War I war debt. You see the World War II war debt. And then what you really see is this current burst, which is quite dramatic and puts us into war-like context in terms of. Having said that, though, if you go to the next chart, we can clearly afford the federal debt. If we end up with $5 trillion of new federal debt associated with COVID relief, it's only about 4% of current U.S. wealth. It's only about 0.6% of the net present value of U.S. GDP. The annual interest cost is only around $50 billion, which is about 0.25% of GDP. And it's only about 1.2% of what the federal budget the federal budget was for 2019. So it's a lot of money. I'm not trying to say 5 trillion is not a lot of money. But as you think about the federal debt, including the new proposed packages, it's not about if we can afford it. We can afford 5 trillion. We can afford another 5 trillion. The question is always, can we afford it? It's, are we getting value for our money? And history generally is we just don't get value for our money. And that's the big problem moving forward. Go quickly, Bruce, down the stretch. You go to the next, you see money supply has shot upward. It will fuel asset inflation. There's a lot of concern about consumer inflation. Go to the next chart. You see consumer price inflation. We always point out core CPI, CPI for services, and CPI for all items. We have a line there at 2.5% just to help your eye. The interesting thing is you've seen an upswing year over year in inflation, but it's largely because last year there was no inflation. You had these bizarre negative oil prices, etc. So we are not terribly worried about consumer price inflation. So if you go to the next chart, there was no inflation in 2020. And as the rebound occurred, we've really gotten 2 years of price increases in a single year. So remember, oil prices were actually negative in April 2020. Think of hotels and air travel, which went to crazy lows, like 20% of what they had been in overnight. And then, yeah, they're up, but they're not up anywhere near their previous peaks. And used cars and rental cars, as I was telling you, the odd dynamics of that. Used cars account for 20% of the most recent CPI overall increase. Come on, that's a crazy situation. That's not normal. That's something that will resolve itself. So what you've got is reduced capacity met rebounding demand to create a lot of transitory price increases. And as those price increases occurred, it's bringing capacity back online. You may have some labor costs be sticky at the lower end of the wage scale after the federal unemployment insurance top-ups end, because to get labor in the face of those top-ups, wages were pushed up. And it's very difficult to overnight push those wages back down. Go to the next. The monetary base, you see QE1, QE2, QE3, QE infinity. We've got more money in the system. So when you look at this chart from back to the dawn of man, but let's just say from 75 to 2008, it was a pretty regular chart, and therefore you had pretty regular benchmarks of asset pricing. Over the last 11 years, you've gotten unprecedented amounts of money injected into the system. Not all of it has come out, but some of it has. And as it does, it fundamentally changes asset pricing. And I think going forward, you're going to get the money coming out again, chasing assets. And if you go to the next, you have bank excess reserves by normal standards. You just have abnormally high levels of bank reserves. You can see we peaked previously in 2014, 2015, and then those excesses ran down as banks lent. And as they lent, you saw asset prices across the board pretty much go up. What you've had now again is these huge injections. The reserves are even higher than they were. They're not coming out yet, but as that money comes out, even if all of it doesn't come out, as any of it comes out, and we get a repeat of what this curve looks like from 2015 to 2019, any kind of repeat of that curve, namely excess reserves diminishing, means a lot of extra loans, and those loans are going to chase assets and push up asset prices. Meanwhile, go to the next chart. Treasury yields stay low. I think they stay low a long time. I think it's counterproductive for the economy. It sends distortionary signals. It subsidizes borrowers, and the biggest borrower in the world is the US federal government, and giving money free to the US government is not such a wise thing. People don't value something when it's free as much as they do as if they have to pay for it. So these artificially low rates, I believe, distort the economy and slow economic growth. However, the prevailing view among members of the Fed is that low interest rates are essential to stimulate growth. I think they're completely wrong. I think the evidence of the last 12 years reinforces that. But whether I'm right or not, they believe it at the Fed, and they're going to do everything they can to keep the long and the short rates down. And they have a lot of tools at their disposal. What that means, go to the next. The Linneman index shows how much money is available for real estate, commercial real estate and multifamily relative to the size of the economy. And basically, you've not seen a sharp drop off. You can see previous periods of distressed pricing occurred back in the mid 70s, then again in the early 90s, then again following the financial crisis. We've not had that precipitous drop off. That means you've not had the precipitous drop in values, the precipitous rise in cap rates. And I think, in fact, this continues upwards and will drive cap rates down. You can see that if you go to the next chart, multifamily, you just see there's a lot of money. Multifamily mortgages outstanding. You got a lot of money chasing. Go to the next, commercial, you see a lot of money chasing. You have not seen the kind of drop off you saw in the 90s or after the financial crisis. You see this still high, which is why cap rates, go back to the earlier chart on cap rates, it's why cap rates have held and values have held. And then the next chart is a repeat of the reserves held by banks, by normal criteria, reserves held by banks. If they've got these kind of reserves, they have no pressure on them to foreclose. And with low interest rates, it's easy for them to refinance forward. And that means very few distressed opportunities. And we predicted 18 months ago that there would not be many distressed opportunities out there. And we still don't see that changing. And Bruce, with that, you can put up our last slide, but is the, you've got the information about Refia and the book and Linneman letter. But with that, Bruce, I'll turn it over to you.
Great. Thank you so much, Peter. As always, a terrific presentation talking about a lot of things, but really just with time permitting, going about, an inch deep. And as everybody knows, the Linneman letter goes much deeper than that on a lot of these topics. And that's a subscription that's available from Linneman Associates. We had several people write in about the eviction moratoriums expiring. What are your thoughts on that and how it's going to impact the market?
So I have one philosophical view, and then I have one market-related view. The philosophical view is, if society believes that you should not evict people because of whatever reason, COVID or other reasons, that's fine. Society has that right to decide that. But my view is, if society decides that, they need to compensate the owners. You can't just take their assets that way. That's not constitutional. It's not the American way. I'm not trying to be a constitutional scholar. I'm just making the point. You don't just impose a tax on building owners. That's one point. The second point is, society did decide they didn't want to evict them. They approved, I think, Bruce, I'm doing off the top of my head, about $46 billion for renter relief. That money has been approved for some time, and I think only $3 billion of it has been distributed. Well, that's disgraceful because, as you know, there are huge backlogs of people who are behind on their rent. I saw a number that there's about $25 billion in arrears on multifamily rent. $46 billion is approved, but only $3 billion has actually been used. Now, I'm not saying everybody who's in arrears deserves the money under the current approval, but that's what it was approved for. Let's get that done. The third thing is, I think it is a little bit of tempest in a teapot. I'm not saying there aren't real people affected. I do think there's a lot of strategic non-payment of rent. And the strategic non-payment of rent, I think a lot of people are going to get their aid money approved. The governments appear to realize they have to process better than they have been. And also, I think some people have the capacity to pay rent and are just being strategic and not. So it will be difficult for some individuals, but I think at a societal level, it will largely be a problem that takes care of itself, particularly in light of the amount of money that's been approved to assist. But it's the equivalent of saying we have huge stockpiles of food in the warehouse that we have bought for food relief, but we haven't opened the warehouses, even though there are starving people outside, and that's unconscionable.
Thank you. Several participants have written in regarding interest rates. From the chart that we saw a few slides ago, it doesn't seem like there's anywhere for them to go but up, other than just sideways. If interest rates start to rise, but the low cap rates, such as for multifamily, are sticky, are we going to get ourselves in a situation where we're going to be having negative leverage on transactions? What do you think probability?
Yeah, so we've written for about 5 years now, the most recent being a very careful piece of research with Matt Lariva from FCP. And we're actually republishing our summary of that research in the forthcoming Linneman letter, because I think it's an important piece of research. Interest rates do not appear to have any notable correlation with cap rates. The primary correlation of cap rates is how much money is chasing real estate, that flow of funds that we were talking about. And I think that interest rates could go up 200 basis points, 300 basis points, but there will be so much money over the next 5 years looking for a home that in spite of higher interest rates, you would get higher values. What that does create is the problem you're talking about, Bruce, which is you could get negative leverage. And that problem says that what you'd really do in the face of negative leverage is reduce the amount of leverage you would take on. So if I'm willing to have 70% debt at today's interest rates and today's cap rates, if cap rates are the same but interest rates are 150 basis points higher, I should want less debt to be sure that I have the same amount of interest coverage and rollover protection. So I think what would happen, Bruce, in the world that you suggest, which could well happen, is the debt levels would moderate a bit so that people still had coverage. Now, you'd still have cowboys, if you will. I don't even mean that in a derogatory sense. You'd still have cowboys who, in the face of interest rates that are higher than cap rates, would simply make real estate a residual bet, not a cash flow bet at all, just a residual bet. And if you win, you'll win big. But if you lose, it'll be very ugly. So first of all, I think interest rates do stay down for a substantial time. I think cap rates drift down as money comes out of the banks, and that will narrow the spread, but I don't think you get to negative leverage on most assets in the next few years.
Thank you. That's very insightful. With respect to vaccine mandates or lack of mandates, for those jurisdictions where they're being enacted, does that pose a real risk, in your view, to retail and hotel for people
This
who
is
are...
this is a very fraught political question. I'll say my own. Yes, it does pose risk that, to the extent we're not all, we now know the vaccines aren't perfect. We never thought they would be perfect, but we know they're quite good. Therefore, we know the more people vaccinated, the more quite good we'll have, and the more quite good we'll have, the better the economy will be. That's economically quite clear. We also know that we run the risk that we introduce major shutdowns because people refuse to get vaccinated, and that's an even bigger economic risk. Interestingly, I'm an old Milton Friedman student. I stress the old. I've been pretty much a libertarian all my life, as witness the fact that over the years, Republicans always believe I'm a Democrat, and Democrats always believe I'm a Republican. But I'm really kind of libertarian, and I tremendously believe in free to choose, free to choose. However, as a libertarian, John Stuart Mill made the point, you should be free to choose as long as you're not imposing notable costs on others, notable burdens on others. And this is a fundamental premise of libertarians. Libertarians are not anarchists. They're believers in choice, but when my choice interferes with your freedom of choice, that's when some type of action is required. from a government because only they can make such moves. To me, this is an obvious case of someone's decision not to be vaccinated is imposing large burdens on others' freedom to shop, freedom to travel, freedom to see their mother in a retirement facility, etc. And we don't have that right. We don't have the right to walk into a school and kill all the kids because we're free to choose. We don't have the right to run over people or blow up people's houses. We don't have absolute freedom under any view of the world, certainly not a libertarian view. So to me, it's a very simple question of, look, you're imposing, by not getting a vaccine, you're imposing negative externalities, negative burdens, reducing others' freedom to travel, to live their lives freely, to shop freely, to see their loved ones freely. In addition, because Medicaid, Medicare, and private insurance, if you get sick or you even get me sick, that burden is being borne by other people, most notably Medicare and Medicaid related. And further, to the extent you fill up the hospitals with something that could be avoided, you've taken away my freedom that if I break my leg this afternoon, they can't treat me at the hospital because they're so busy dealing with something that could have been dealt with far more effectively. So I don't view the vaccine issue as an issue of freedom of choice. It is a societal, you're taking away the freedoms of others. And on fundamental libertarian, it seems, now I understand not everybody's a libertarian, but I do find it offensive when, as a libertarian, when people kind of use the free to choose mantra totally incorrectly. Because if you say you're free to choose anything, you're free to walk into a school in a week from now and kill everybody you want to kill, simply saying, well, that's what I wanted to do. That is not what free to choose is about.
On that note, we had a couple people write in related to the possibility that private insurance companies might say, we're not going to pay for COVID treatments if you were unvaccinated. Do you see the possibility of that scenario?
Yeah, Ronald Coase, a Nobel Prize winner, Ronald Coase. I knew him, I didn't know him super well, but I knew him. He was a senior faculty member when I was at the University of Chicago, had a famous article wherein he described that it is not only government that can solve these situations where one person's decision imposes harm on others, but rather other private parties can take actions that deal with it. And what you just described, Bruce, is exactly Coase at work. C-O-A-S-E, Ronald Coase theorem at work. Namely, while a private insurance company can simply say, we're insuring against intelligent behavior or rational behavior, whatever you want to call it. This, by the way, as you know, has been an issue about smokers and obesity and a lot of other things in the private insurance. So yes, it could happen in the private movie theaters, shopping centers. I mean, imagine if Walmart and Target and so forth, Kroger's said you're not allowed in our stores unless you show your vaccination card. I couldn't fly to Germany without showing my vaccination card. I didn't view it as an infringement on me in any way. So I do think the private sector has a real Coase responsibility, whether they're employers or suppliers or providers. You know, you're seeing it with universities saying, if you want to be at my university, you're seeing hospitals. I think it's Houston Baptist was in the lead in this regard, saying, if you want to work for us, you've got to do it. So I applaud the private employers, the private service providers for taking coast-like actions in the absence of what I would view government action. And basically, I never like government action except in the most extreme cases. But this one seems pretty obvious. So I applaud those efforts.
Thank you for sharing your thoughts on that. We are at the top of the hour here, and unfortunately, we're not going to be able to get to all of the questions that come in. But I want to make everyone aware that a lot of what's in this presentation and much more is covered in great detail in the Linneman letter, which is the subscription available from Linneman Associates. And more information can be found on that naturally at your website, linnemansociates.com. And there's other interesting offerings there as well, such as an educational video series and our refi certification program. As a reminder, if you registered, you will automatically receive an email link to the recording of the webinar in about an hour. So with that, Peter, thank you again. I hope everybody stays safe and well, and we will see you back next quarter.
Thank you very much, and everybody stay safe and enjoy the rest of the summer.
Thank you.
Bye-bye.
Bye.